Welcome to The Swing, the official newsletter of the Forex Trade Room, Volume 11, March 15, 2024. The dollar is holding strong at around 103.4, securing its first weekly gain in 4 weeks amidst fears of inflation fueled by higher-than-expected U.S. consumer and producer prices in February. Market expectations for a Federal Reserve rate cut in June dipped to around 60%, down from 74% last week. However, the Fed is anticipated to maintain steady rates in March and May despite the inflationary pressure. The dollar experienced widespread weakening this week, notably against the Kiwi, yen, and sterling. The Australian dollar slipped towards 65 cents, hitting its lowest levels in over a week. This was driven by stronger-than-expected U.S. inflation data, raising doubts about the Federal Reserve's future interest rate cuts. Additionally, Australia's economy expanded less than expected in the last quarter, prompting speculation that the Reserve Bank of Australia may initiate rate cuts. Market sentiment indicates a 70% chance of the RBA reducing its cash rate in August, with an expected total easing of 40 basis points for the year. The Canadian dollar weakened below 1.35 per USD, hitting a one-week low amidst uncertainty over potential U.S. Federal Reserve rate cuts. This was influenced by U.S. inflation data, which buoyed the greenback. Additionally, in the U.S., producer prices remained high in February, dampening expectations for rate cuts. Meanwhile, Canada's domestic indicators showed mixed results, with initial jobless claims below expectations and retail sales expanding. Despite this, the loonie's decline was softened by foreign currency inflows, driven by tightening crude oil inventories in the U.S. and escalating tensions in the Middle East, which lifted oil prices. The yen slipped below 148.5 against the USD, retreating from recent 5-week highs as anticipation builds for the Bank of Japan's monetary policy decision. There's speculation that the central bank might abandon its negative interest rate policy, driven by news of a wage increase by Rengo, Japan's largest trade union. However, the market seems to have already priced in this potential shift, raising concerns about the pace of tightening. BOJ Governor Kazuo Ueda also provided a slightly downbeat assessment of the economy, mentioning moderate recovery but acknowledging weaknesses in certain economic data. The New Zealand dollar fell below 61 cents, hitting its lowest levels in over a week. This was driven by stronger-than-expected U.S. inflation data, which cast doubt on the timing and extent of potential Federal Reserve interest rate adjustments. Chief economist Paul Conway of the Reserve Bank of New Zealand suggested that if the U.S. Fed cuts rates later in the year while New Zealand maintains high rates, the Kiwi could strengthen. However, he warned that this scenario might prompt the RBNZ to adjust monetary policy sooner than anticipated. The Swiss franc held steady at 0.88 per USD, showing a steady rebound from its 3-month low, supported by robust economic growth. Switzerland's GDP expanded by 0.3% in Q4 2023, surpassing expectations. However, concerns over sluggish inflation persisted, leading to speculation of an SNB rate cut in March. Headline inflation dropped to 1.3% in January, below expectations, attributed to changes in electricity subsidies and value-added tax. The British pound held steady at $1.28, staying below its recent peak, as investors processed economic data ahead of the Bank of England's interest rate decision next week. January's GDP showed a modest 0.2% growth, driven by retail and housing sectors. Meanwhile, the latest jobs report revealed a 6.1% year-on-year increase in regular pay, slightly below expectations. The BoE is expected to maintain rates next week, with markets eyeing a potential rate cut in August, later than anticipated moves by the ECB and the Federal Reserve. The euro lingered just below $1.09 as European Central Bank policymakers maintained a cautious stance. Investor focus shifted to the US dollar following higher-than-expected inflation figures, reducing expectations for a June rate cut by the Federal Reserve. ECB Council member Olli Rehn mentioned discussions about rate reductions, suggesting a possible cut by spring or early summer. Despite record-high borrowing costs, the ECB hinted at preparations for its first interest rate cut after revising down inflation expectations. The Mexican peso weakened below 16.7 per USD, stepping back from its recent high due to dollar strength. In the US, retail sales rebounded in February, along with a rise in producer-side inflation, bolstering the greenback as hopes of Fed rate cuts faded. Additionally, US jobless claims decreased but didn't meet expectations. In Mexico, industrial production recovered in January, surpassing December's performance, while subdued inflation in February supported a hawkish stance. WTI crude futures settled at $81.04 per barrel on Friday, slightly down from recent highs but still marking a weekly gain of over 3.5%. Strong U.S. demand and optimism about global oil consumption fueled this rise. Surprising data from the International Energy Agency showing a decline in U.S. crude inventories, along with upward revisions in global demand forecasts by the EIA, boosted prices. Geopolitical tensions, including Ukrainian drone attacks and ongoing Middle East issues, combined with OPEC Plus supply cut extension, further supported oil prices. Gold held steady near $2,160 an ounce, facing its first weekly decline in 4, amidst uncertainty surrounding Federal Reserve rate cuts. Higher than expected CPI and PPI data, along with lower initial jobless claims, prompted investors to reassess their expectations for monetary easing. Chances of a Fed rate reduction in June dropped from 74% to 58%, impacting the appeal of non-yielding assets like gold. Nonetheless, gold remained close to its all-time highs, serving as a hedge against inflation and geopolitical tensions. U.S. stocks closed lower on Friday's second session, marking the first triple witching of 2024. The S&P 500, Nasdaq, and Dow Jones all saw declines amidst significant options expiration and a major tech sell-off. Investors awaited the Federal Reserve's decision next week amid speculation about potential interest rate cuts. Recent data showing higher than expected CPI and PPI figures fueled speculation of postponed rate cuts. Tech stocks, including Microsoft, Apple, Amazon, and Alphabet, saw notable declines. Nvidia ended slightly lower, while Adobe sank 13.6% due to disappointing quarterly guidance. On the week, the S&P 500 and Dow Jones gained, while the Nasdaq saw a slight loss. In the week ahead, all eyes will be on the Federal Reserve meeting, where the FOMC's economic forecasts and dot plot interest rate projections will be released. In the U.S., key indicators such as manufacturing and services PMIs, housing data, and existing home sales will be watched closely. Internationally, interest rate decisions from several countries and inflation data from Canada, the UK, South Africa, and Japan will be in focus. Flash manufacturing and services PMIs from various countries will provide insights into global economic activity. Additionally, updates on industrial production, retail sales, unemployment rate, fixed asset investment, and loan prime rates from China will be crucial for market analysis. That brings us to the end of this week's Swing newsletter. As a reminder, don't forget to tune in for Mindset Mondays with Ryan Carthage starting at 6:30 a.m. Eastern Standard Time. Enjoy your weekend and good luck in the markets next week.